Hello, everyone, and thank you for joining us today. I am Caitlin Spain, Trilogy's Product Operations Manager, and today we are doing our quarterly market commentary call with insights presented by our Chief Investments Officer, Mike Serio. Today we have him joining us to share economic perspectives and market insights that will connect the dots from the past, shed light on the present, and help us navigate what's ahead. If you have questions during the call today, please note that we have an email address you can send those to, and we'll address those at the end of the call. That email address is investment.team@trilogyfs.com. So at any time during the call, feel free to send questions there. And again, we will address those as we have time at the end of today's call. To introduce Mike, he is the Chief Investment Officer at Trilogy Capital, and he is responsible for investment strategy and client communication. He oversees more than $4 billion in client assets with us. He has over 30 years of Wall Street experience as a portfolio manager, strategist, and chief investment officer. He's been frequently quoted in the Wall Street Journal, the New York Times, Bloomberg, the Washington Post, and other publications. He's a former adjunct professor at the University of Denver and DePaul University. He also worked on the Russian project for the United States Agency for International Development in the formation of capital markets in the former Soviet Union. He has also earned a bachelor's degree in economics from the University of Illinois, an MBA in finance from DePaul University, and he is a CFA, a chartered financial analyst, as well as a CAIA, a chartered alternative investment analyst. With that, Mike, I'll turn it over to you today to share the information that you have for us.
Great. Thank you, Caitlin. Boy, what a 6 months we've just gone through. I'll tell you what, over the years I've been doing this, I've never seen more emotionally charged investing versus clinical investing. And that's where we're going to go with this right now. Let's go back to the first page. It's going to be I call it the importance of being clinical. And what we're going to do is go through how important it is to be clinical. When I say clinical, that's investing with your head, not your heart. So we're going to go through that. We're going to go through some historical data that guides us in clinical thinking and investing. We're going to have some macro thoughts, what's going on in the economy, what's going on in politics, most importantly, what's going on in the world equity markets. We're going to go through some of our tactical portfolio updates where we're taking tactical positions, some international equity comments where the opportunities are. And then at the end, I'm going to kick it back to Caitlin and give you an opportunity to ask questions. So let's start with comparing clinical way of thinking about things versus emotional. A clinical way is such as a doctor, and I learned this a long time ago. My father was a surgeon, and I asked him when I was a little kid, I said, Dad, why don't you ever see any of your patients, any family members? And he said, Michael, we got to take the emotion out of it, and I have to practice medicine the way I've been taught, and I have to do it without being emotional. And we have to do that in investing too. We have to be somewhat coldly detached and implying an objective attitude, and don't bring any prejudices in there. When you're emotional, you certainly have a complex series of consciousness, body sensations. You bring a lot of prejudices in it, and that's certainly not the way to do it. I'm going to quote Warren Buffett twice today. We'll start with the first one: is you don't want to be a no emotion person all your life, but you definitely want to be a no emotion person when making an investment or a business decision. Now, boy, what a first half we had. So January 1st or January 2nd, whenever I got into the office for the beginning of the year, if you would have told me the following things would have happened, and we all had a perfect way of predicting things, I would have said that this market would have been down at least 25% right now. So when we go through what has happened, the first one would be fears of a global trade war because of that, quote, Liberation Day. At that time, global markets seemed to be shutting down. The world seemed to be coming to an end. It didn't look very good. And this was something, though, that was brought on by the stroke of a pen. and it was solved at least temporarily by a stroke of the pen. We had the big beautiful bill pass, which if it did not pass would have been the largest tax increase in US history. The big beautiful bill, certainly happy that got passed. There's some things in there as an economist we really don't like, such as the spending. We'll touch on that a little later. The third credit agency downgraded US debt. Both Moody's, Fitch, and S&P now have downgraded U.S. debt a half a notch. You would have thought the world would have gone into a real tizzy because the true only risk-free asset in the world is the U.S. Treasury. I'll go through that, why it will continue to be the only risk-free asset in the world, and why it will continue to garner demand from abroad, and the U.S. dollar will continue to be the reserve currency of the world. If we would have said we were going to have a war between Israel and Iran, there would be a good chance we'd be in the middle of World War III right now. Certainly to date, that has not happened. And that led to the U.S. taking out 3 of Iran's nuclear enrichment sites. The U.S. came in quick. They left very quick in a matter of hours. And to date, and I'm going to say this quite a bit because you don't know what the crystal ball is going to say in the future, but to date, it's been somewhat successful. And this all culminated in a near bear market in stock prices. A bear market is defined by a market top to bottom of down 20%. Intraday, it was down 20%, but that day it closed down approximately 19%. So again, if you would have said to all of us here at Trilogy, if those number of things happen, where would the market be? And then I showed you this chart. It would be unbelievable. As of the end of June, and actually today, we are at or near, depending on what market you look at, an all-time high. And I find that very fascinating that despite Liberation Day, despite potential World War III and all these things, that markets continue to power ahead. And that's a real positive. And what we're going to do is we're going to learn some things from there. Caitlin told you how long I've been doing this. What I try to do is at the end of every year is write down, what did I learn this year? And we're going to go through some of those, and we're going to go through a half year. What did we learn already? When you look at the other markets, and this is a chart that's quite interesting, you will see the red dots where the drawdowns of all these asset classes for the first 6 months of the year. DM is developed market equity. That's international equity markets of larger countries, such as in Europe. EM's emerging market equity. They didn't do very well. You'll see that US large cap number I talked about down about 19%, US small cap down about 24%. Post-Liberation Day, we've had a large rally, and you can see that the gray lines above is where we were at on June 30th of this year, and you can see we've had a near unprecedented snapback. Now, when you take this chart and look a little longer term, I find this very interesting because sometimes with clients, you have to go back to the basics and go back to history, and history lets us understand what's going to happen in the future. You will see, and this is a pretty robust chart going back to 1993, and it discusses and it shows us what year-to-year U.S. stock market returns have been through those maroon colored lines. You'll see on average it's done about 9.9% over 20 since 1993, not without a bit of volatility. And I find this interesting that when you go through those 32 years, 23 have been positive. So approximately 3/4 have been positive. And on top of that, the average drawdown per year is about 14.6%. Certainly what we would call a correction, which would be down 10%, not quite a bear market. But you can see that this asset class certainly over long periods of time has done very well for investors, but not without some volatility. And that's where the planning function comes in with our advisors, is not everybody can handle this type of volatility, which is why in all of our models, we have 6 risk levels. Risk level 6 would be that risk of the market going all the way down to risk level 1, which has approximately 35% equities. Now, I'm going to just touch on politics here for a second, and this was a very interesting one. When you look at partisan investing views, and again, these are people who might be investing with their heart and not their head, you can see where the Democrats and the Republicans are on their views who's pessimistic on the stock market, who's optimistic on the stock market. I don't even have to go into that. And you can see where they are right now. But again, as we go back well over 100 years, history tells us it's better just to leave politics out of investing. No matter what party has what branch, markets have a tendency to do well. It has more to do with the economy. And believe it or not, politics has less to do with the economy than you might think. Buying, blinding buy and hold beats holding when one party has reign, and it really has no input into what we are doing on the investment side. Although it's important to be able to take these policies and understand their effects on the market, certainly trying to invest, depending on what party is in charge, is a worthless fool's game. Another way of looking at it is we have to take the hard data, which is the data that we actually get, versus what we call the soft data, which is more polls, sentiment indices et al., and find out what people expect. And here's one that's interesting that I pulled up about a week or two ago. It's called the Misery Index. The Misery Index is composed of the CPI, inflation, plus the unemployment rate. And those are the two things that are the Fed mandate. The Fed, its job is to keep inflation under control and to lower the unemployment rate as much as possible. And you can see the last print here, the actual Misery Index is about 6.6. And that's actually pretty good when you go all the way back to 2000, pretty good, nice, robust 24 years of data right here, but you can see the emotion in the market. The expected misery index was almost twice as high. And that's telling us that, again, there's a lot of emotion in this market. And I think the best thing we do being an advisor is certainly keeping people on track. Another way to look at this is looking at US policy uncertainty. Now, these numbers really don't mean anything, but at any one time, there's a group called policyuncertainty.com that takes a look at what the federal government's doing. And there's, times that you are very certain about what's going on with regards to tax rates, with regards to depreciation schedule at all. And there are times you are very uncertain about it, like we were at the beginning of this year, is what are the tariffs are going to do? Are we going to get the bill passed? And you can see all sorts of these uncertain things we were dealing with. But I find it interesting that when you look at when policy uncertainty is at its highest, and that's that uncertainty of 200 plus, market returns, once you get out of that policy uncertainty, look pretty darn attractive right here. Post 1 year return on average, and this goes back to 1985, is about 20%. So one thing we are always taught when we're young investors is you have to have a bit of a contrarian bent. And when, again, this is another example of having a contrarian bent. When everybody's selling, you should be thinking about doing some buying. Another example would be U.S. Equity performance prior to and following start of major U.S. military actions. This one goes all the way back to Pearl Harbor. Ending with Libya. You can see that 125 trading days later, certainly, sometimes they're down. The one I want to point out is certainly 9/11 in Afghanistan. There were some other things going on there, mainly a recession involved with that. But you can see as that market traded down following the start of major military actions, that was actually a good time to buy. Things go on sale, and you look at some of the great companies we're invested in, the tech companies, they're no different than they were before and after these major U.S. military actions. So again, we look to buy and to get somewhat aggressive when things go on sale. This one I just found, I thought this one's kind of fascinating. Looking at the beginning, January 1st of every year, going back to 2000, and this lists some of the bad things that happened on a year-by-year basis. And when you look at January 1st, more than likely that's before the event. So if you invested your money on January 1st, let's say of 2000, you went through the tech wreck, you held it until December 31st of 2024, you garnered 538%. Now, we've been through some pretty bad ones here. You can see September 11th. You can see the global financial crisis, which was probably the worst event of my career. The GFC, again, the market was down 56% in the depths of despair. You still garnered 788% after going through that. You had another one just a couple of years ago, COVID-19, that pandemic. That was quick. Market snapped out of it. But even going through that bad event, the market returned 97%. And if you look at all these years, there's really only one that we had to really find something. 2006 was actually a much better year than we thought. Worst thing we can come up with is Pluto demoted from planet status, which really didn't have anything to do with anything, but you can see how good of a year 2006 was. So how does this translate into investing? And this is a famous chart that keeps getting updated. And when you look at returns going back 20 years, you can see the US stock market has compounded almost 10% a year, 9.7%. That's quite attractive. REITs, international equities. But then you have to ask yourself, and this was, you can see if you look closely, the source is ClearBridge, Franklin, Bloomberg, some pretty solid outfits that give us some very good information. Unfortunately, the average investor only compounded their money in that time frame by 3.4% a year. And when you look at that and compare it with inflation, they're barely beating inflation. So why does that happen? Well, I can tell you that it's emotional decision making, and a lot of times that leads to panic selling. Like some people, I do have CNBC and Bloomberg on my TV all day during the working days, have to shut it off at night because it'll drive you crazy. But I will tell you, probably 7 out of 10 people are going to be asked, these experts, what's the market going to do between now and the end of the year? And frankly, nobody knows. And when you see that the average investor tries to get in and out of the market and time these things, it just does not work. So it's much more important to stay invested, to buy quality companies, to take your tactical moves, what we call in between the 40-yard lines and not goal line to goal line. And most of the time, and I would say if you just give it enough time, your plan and your investment program will work. So let's talk about why doom scenarios attract so much attention. And I was taught this by Dr. Eric Davidson, who's a professor at Baylor University, has a PhD in behavioral economics. He always pounded on us when he was my boss in another institution. There's 4 things you have to be worried about when you're dealing with clients and how emotional things can get. And the first one is evolutionary psychology. Man, all of us are hardwired for threat detection. That's one reason we've been around, depending on which study you looked at, 200,000 to 400,000 years. And it's actually safer to overreact and overreact to the saber-toothed tiger than underreact and get eaten. So that hasn't gone away. The amount of adrenaline people get going and cortisol get going when we get nervous basically kept us safe for all these years. But in investing, that certainly turns us sometimes into emotional investors, which was what we don't want to do. The second one is loss aversion. The basic study of economics always assumes that people are rational. So when something's higher priced, you buy less. When something goes down in price, you buy more. That's rational thinking. But the problem is when you look at behavioral economics, people, the way they act, don't always act as rational as that. And one example is people dislike losing money 2 times as much as they like making money. And that's loss aversion. So when and certainly I can understand it. We all can understand it. You work hard for your money, you invest it, you don't want to really lose it. But then again, that's contrary to what you have to be, is that when markets are down, good investments go on sale, you should actually have a higher risk tolerance. But we don't see that longer term the way markets act. The next one is the doomsayer archetype. And you can just see by turning on the national news every evening and see how many positive reports they have. Do they tell you, well, heck, inflation's actually has come down. It's not that bad. The unemployment rate really has come down. That news doesn't sell and that news doesn't get clicks. Let's just say fear sells, and we all know that. So sometimes when you get bombarded with media, social media, it always seems like things are bad. And I've had a number of client meetings over the past 3 or 4 months, I don't know, 30 or 40. And a lot of times I have to fend off the what if scenarios. Certainly, some of those may come to fruition, but most of the times they don't. And if you're a what if person, I will tell you, it's going to be very hard to meet your financial goals. And then finally, recency bias. Recency bias tells us you look at something like Liberation Day and what happened then is going to continue to go on in the future. Rarely does that happen. We have to go back to the charts I showed you and say, hey, over long periods of time, there's something called reversion to the mean. Things go back to normal. It'll be okay. Now, unfortunately, sometimes it takes a while, and I've been through a couple of nasty bear markets, and sometimes they last as long as 3 years, and that's not any fun. But then again, you have to stick with the plan. Okay, so when you look at this again, but yet, despite all that bad news, again, markets had the best rebound following a near bear market. You look at operating margins down there. That's estimated next 12-month operating margins of the market. They're near all-time highs going back to 2011 of almost 18%. And now we're getting the return of that magnificent seven group of great technology companies being able to drive market earnings, and that's a real positive. Now, I talked about a little bit about politics, and you have to understand what's going on in the administration. And at any time, you're going to get tailwinds, and at any time, you're going to get potential headwinds. But I'll tell you what, let's start with the positive. We have a real pro-growth policy out there with lower taxes. We've got a pro-growth policy with deregulation and business incentives. To grow this economy, you're going to need a number of things, and one of them you're going to need are the return of what we call animal spirits. These are entrepreneurs ready to go out to commit their personal capital, to borrow money, to have a new idea, to hire people, and that's what makes our country so much better. I'm going to talk about American exceptionalism in a second. But we do need government to grease the skids of capitalism. And then finally, this administration does understand markets and support, and that's always good for investors and certainly good for our clients. It's not without headwinds, though. There continues to be trade tensions and tariffs. We got some today talking about putting 100% tariffs on countries that use Russian oil. Again, what I do worry about is this big, beautiful bill is the deficit and debt concerns. I'll get to that again in a second. I think longer term, that's a real headwind for us, if not something we really need to be concerned about. And certainly there continues to be policy uncertainty out there, and we've talked about that. Let's get to tariffs and what's going on the macro sense right now. I find this interesting is you take a look at household consumption expenditures. That's that blue line down there, and all the tariffs right there. And you can see that dotted red line have gone up pretty significantly and created enormous uncertainty. People continue to spend, and that's very important in that that's about 70% of our economy is consumer spending. Private consumption has been steady besides these tariffs. We're going to go to one way we look at global trade, and that's the Long Beach vessels off the port of Long Beach in Southern California. That's that red line up there, and you can see Long Beach vessels are still queuing up. Sometimes they have to wait days or weeks to be able to load their goods onto trucks and so forth to get them delivered throughout the United States. That's still rising, and that's a real good sign. Now, part of this could be what we call front running. A lot of companies trying to get that those exports and imports moving before the tariffs take hold. That line may flatten out or possibly come down in a bit. But then again, no matter what the news is telling you, trade is still taking place, and it's not the end of the world. Next thing we're looking at is inflation. And you can see where we are on a year-over-year basis. Natural gas certainly being very high. It's the most volatile commodity out there, very difficult to trade. But you're looking at housing starting to come down 3.8%, food. You'll see all items 2.3, and a lot of things we use all the time, such as gasoline and other things, have actually come down in price, and we've had a bit of deflation there in televisions, airfare, hotels, and motels. So that's pretty good. Let's get to some of the things going out there, which does worry us. And that's, as I mentioned, government spending outpacing revenue. You'll see federal net outlays as a percent of GDP, significantly higher than federal receipts as a percent of GDP. We actually need that line to narrow a little bit. But unfortunately, look at the Congressional Budget Office, which is a supposed nonpartisan accounting group that tells us what's going to happen. They project a full year deficit to hit 1.9 trillion. Now think about 1.9 trillion dollars. I'm going to get to what a trillion means in just a second, but at the end of the day, a child born right now, before they take their first breath, will have debt on their backs of about $89,000 per person, and that's before you build one road, pay one teacher. We are spending the money our grandkids are going to earn right now, and we've got to be able to fix that. So when you look at a trillion, it may not seem like a lot of money. This is a good way to explain it. $1 billion first is a lot of money. A trillion is 1,000 billion. And again, we talked about the budget deficit. Now we get to the national debt. That's 36.2 trillion. That's 36,200 squares down there. It's certainly a lot of money. And as somebody once said, you know, a trillion here, a trillion there, pretty soon you're going to have a real deficit. And if we're not careful, we're going to have a huge deficit that's going to take many years to get out of. So let's go through some of the markets here. As I showed before, to date, international certainly has been the place to be. But if you look at international investing, and we still have positions in international in our level 6 portfolios, about 10%. The only period when international stocks outperformed the S&P was between 2002 and 2007. They're doing that right now. EFA is Europe, Australia, and the Far East, outperformed the S&P 500 index by 80% during that time, which is why we don't try to tactically play that. We keep what we call a strategic position in international. We've lowered that a bit over the last year. Actually happy we did that because that's really helped with performance. Now, I talked about U.S. exceptionalism. Do we think that would continue? I would say absolutely. When you look at corporate earnings growth, that is the ultimate factor dictating equity prices. As I talked about, it's companies selling stuff, bringing that to the bottom line, and giving shareholders either dividends or reinvesting in their company, raising stock prices. So let's look at international corporate earnings growth versus the U.S. You can see the U.S. is that blue line, international is that red dotted line. I can't see that changing anytime soon. So we're going to continue to have in our mix of assets a much bigger weighting to U.S. stocks than will be international stocks. Okay, I mentioned U.S. debt. Here's the total foreign holdings of U.S. treasuries. Ordinarily, we relied on China, on Japan to buy a lot of our treasuries. Believe it or not, compared to what the news is telling you, they're still buying our treasuries because there's no substitute for U.S. treasuries in the world. And actually, the last click is starting to rise again. In fact, throughout the world, it's really difficult to find a riskless investment such as the U.S. Treasury. Let's go to some of our tactical positions where we think the opportunities might lie. And the first one is the different kind of a unique kind of industrial revolution going underway, and that's the increase in demand for power. It started with electric vehicles, and now it's artificial intelligence. If you've been tuning into these calls, I'm going to repeat myself a little bit that a ChatGPT takes about 10 times as much power as a Google search does. About 10 minutes ago, I saw on CNBC that Meta is going to build some plants, and when you put them all together, they're going to be about the size of the island of Manhattan. So we're looking at taking advantage of construction spending because of this huge demand, we're going to have to build more data centers, and there's going to be such a demand for power. We are actually, for the first time in my career since 1986, going into utilities, and we've been in utilities now almost a whole year. And there's a business case for utilities rather than just a high dividend, low volatility type investment. So you look at the power of artificial intelligence, it's going to be able to provide productivity gains and hopefully get that GDP growth back to about 3%, which certainly will help with the budget deficit and bring us all the things 3% growth brings us, such as better healthcare and better schools and different things like that. You can see where the change in construction spending is going. Again, data centers off the charts. You'll see computer, electrical, things like that. That's where our industrial investments are on the upper part of that chart. And if you go down there, you can see where changes in construction spending have actually been negative, certainly staying away from those areas. The other thing we found interesting over the last 6 months is how the price of energy has been reacting. Now, we just talked about how the world's needing more energy. That is true, but you look at gasoline is coming down for a number of different reasons. And I found this very interesting, that when you look at what we're doing here in the United States, given the shale revolution, given the ability and the technology for us to go down and frack, we have about 5 more generations of BTUs under us than we actually thought 20 years ago. And the chart on the left, or actually looking in the middle, is you'll see the net imports of crude and petroleum products. We are actually now a net exporter of crude. And I found that very interesting, that we don't rely on Iran, Iraq, and the Saudis to fund what we're doing in the way of energy. And that's a real positive. The other one that was interesting is whenever Middle East tensions have risen, there was always worry that Iran would shut down the Strait of Hormuz. And you can see the map on the right and how important that is, that about 20% of all petroleum gets moved through that narrow strait. And if Iran ever chose to close that, the price of oil, given what we call the elasticity of it, would rise precipitously. But you look at what Iran needs. There's no way they're going to be able to close that right now because their main customer is China, and if they can't move oil out of there, Iran exports 2 things: oil and terrorism, and the terrorism business has much been shut down. So they just need that oil to continue flowing through the Strait of Hormuz, and that gets very important. And why oil, when you look on the next one, oil production to real GDP on the lower right is as low as it's been. So we are actually not all that dependent on oil, despite what's going on with AI and the need for electricity. Let's go and next just kind of end up with a couple things. Update on Trilogy tactical sector positions. In our tactical portfolios, we have overweights in discretionary. Excuse me. Nope. These lines are a little off. I apologize for that. It's actually in communication services. Year to date, that's up 11.13. You'll see it in utilities down there, 941. Information tech and industrials, 12.72 and 805. I should make sure I readjust this chart next time I do this. Finally, let's end up on some good news. And again, I always like to say that optimistic people are wealthier, happier than pessimistic people. I found this interesting, how long people are living. That's a good thing because, certainly everybody wants to live a long and, more importantly, a healthy life. Women, now, if you don't smoke, you can look that you have a 73% chance of living till about 75 right now. I find that's interesting. A 10% chance if you don't smoke of actually making it to age 100. Men are a bit lower, but you'll see both members of a couple, or at least one of a couple. You can see how important it is. There's a 90% chance one of those makes it to 85. So that's a real positive, but it kind of changes our business in a way that we have to start planning much farther out. When I got into this business, we started, we ended people's plan at 70, 75. We're actually going to have to start planning to make sure people live to 100. And what changes the way we view things is they're going to have to continue to invest in a little riskier assets because their time horizon is so much longer. So that is one of the things we are putting into our planning process. And let me end here before I kick it back to Caitlin and go to questions with my last Warren Buffett quote of all. This one I really love is, don't bet on the end of the world. It only happens once. So Caitlin, let me kick it back to you and see if we have any questions out there.
Perfect. Thanks, Mike. Always appreciate your insights. Your education goes back a long way, so it's helpful to have your perspective and backed by the data and the research that you do on all of this. We've got some questions on the big beautiful bill today. So one of those being, I think there's some concern around the national debt and government spending as a result of some of this. What are the potential long-term implications that you see of this for client accounts and specifically for the overall stability of the markets that we invest in?
Okay, there's a couple theses out there. That's a great question. The first one is, if we continue to grow our economy 2.5%, because think of 3% as what we think we can grow our economy at, we're going to have to continue the way we spend to borrow more and more money. And that might have the effect of crowding out some companies and some entities that might need to borrow. Because the government is competing for funds with private companies. And if the government debt continues to grow at the pace it has been, they're going to have to pay more and more in the way of interest. Again, that's the risk-free rate. Companies are going to have to pay an interest rate somewhat above that, and that may have the effect of slowing down growth. One of the tactical themes we have, it's called S&P aristocrats. These are companies that don't need to enter the debt market. So they're self-financing. They care less what interest rates do. So that is one of their tactical themes. Another way to think of this is we get worried about is organically, the United States is not growing. One of the things I don't think this administration has right is completely limiting immigration. We do need immigrants because we're only having 2.1 kids per family. And when you factor in people that don't get married, we're organically contracting. And if you want to look at the ghost of Christmas future there, you can look at Japan. Their interest rates went to zero. And if you think high rates are bad, you should live through 0% interest rates. And if you can't bring people in, there's nobody to service Social Security. Everybody gets old, and that's a bad recipe there. So that's a long-winded answer to a very good question.
Great, thank you. This one ties into it as well, going back to the quarterly update that you had written for the quarter. So it stated that the tax bill that addresses the tax cuts, which were subject to sunsetting, was passed and will provide tax relief to the consumer. So who are the consumers that are actually going to get any tax relief from that?
I don't know if I'd say consumer, I would say constituents. Okay, when you look at it, these are people making a good part of their money getting tips. I've got to look closer into this, and it's going to apply to me. At some point, it's going to apply to all of us. Is how much in the way of tax relief we get on Social Security payments, and you have the SALT deduction, state and local taxes that were limited to $10,000. I found it. I had questions back in 2017 why that was. Well, the federal government did not want to subsidize high spending states, which is why they limited those deductions. But now that's been raised, if I get this right, to about $40,000. That's been a real burden because, if you live in New York City, $10,000 of state and local taxes is absolutely nothing. You've got to be actually on subsistence level to when you're paying that. So those are some of the constituents that may apply to.
Great. You talked a little bit about the IFA and its outperformance from 2002 to 2007 of
Mhm.
the S&P. So from an international perspective, we can't time when that's going to happen again or when it
Yep.
might happen. So what is
Yep.
the firm's current strategy regarding international investments? And do you foresee a shift in this US exceptionalism trend in the coming years that might impact the way that we choose to diversify?
Okay, another great question. When you went back, if I could go back and look at the chart, most of that underperformance by the US had to do with a weakening dollar. So if you're in another market, you've got two components of return. You've got how those markets do, and then you've got the way the currency moves. So you have to be pretty savvy both with picking investments and judging where the currency is going to go. Okay, so that's mostly where that happened. And when it happens quickly, it happens fast. I look at what happened this year as maybe a valuation difference. When you look at the value of those international equities as a market, they are historically extremely cheap versus the US. Now we have to ask ourselves, why are they cheap? If you've been listening for a while, you can see some of my best investments have been buying cheap things. Some of my worst investments have been buying cheap things because there's a reason that they're cheap. I'd like to say US exceptionalism will continue because where's our earnings growth coming from? And that's in technology. Now, when you look at the United States, and let's go back to 96, 97, 98, 99, the internet came, it was changing the world. We had a whole bunch of that animal instincts coming on, looking for capital, creating companies like Ask Jeeves, MySpace, Google, drcoop.com, a number of different companies. Now, what happens in technology is you get a whole bunch of companies coming in, they each have an idea, they get filtered out. The best and the brightest make it. They become the next Tesla. They become the next Netflix, and the rest of them go away, and those assets are redeployed somewhere else. Now, when you look at Europe, that doesn't happen because not to have too much of a political commentary there. They're socialist people. You can't lay people off as easy. I know I have a friend who has a private equity firm. He went to go buy a plant in Germany. There's all these people standing around, and he asked the owners, he goes, what are all these people standing around doing, not doing anything? He said, well, you can pay them to come to work or you can pay them not to come to work. So it's much harder to develop technology in other areas where the US is much easier. And unfortunately, it's bad for the other employee, but longer term, it's actually good for the employee. You'd rather be working with a company that's selling things and expanding rather than one that's just babysitting their employees.
Great. Awesome. Mike, thank you so much. And thank you everyone for joining us today. We'll go ahead and wrap up. I've got a reminder for you all on the next session. That's going to be Monday, October 13th at 1:15 p.m. Pacific time. So these happen every quarter, and that will be our next one. As a reminder, we are here as a partner on your journey toward your financial goals. If you have any questions at all after today's call, please reach out to your financial advisor. If you don't have an advisor, feel free to reach out to Mike or to me. You can email that investment.team email address, and we'll make sure that we get back to you with some information. So thank you again for joining us. Thank you all for your questions, and we'll see you in October.